Introduction. In the world of investment, various vehicles promise opportunities for wealth accumulation and financial security. Among these are hedge funds and index funds, two contrasting investment approaches that cater to different risk appetites and financial objectives. This article will delve into the fundamental differences between hedge funds and index funds, highlighting their unique characteristics, investment strategies, and potential benefits and drawbacks. 1. Definition and objectives. Hedge funds. Hedge funds are private investment funds that pool capital from accredited investors and institutional clients to pursue diverse investment strategies. Their primary objective is to generate absolute returns, often regardless of the broader market conditions. Hedge funds use various strategies, such as long-short equity, arbitrage, and derivatives, to capitalize on market inefficiencies and achieve positive returns in both rising and falling markets. Index funds. Index funds, on the other hand, are a type of mutual fund or exchange-traded fund, ETF, that seeks to replicate the performance of a specific market index, such as the S&P 500. The primary goal of index funds is to match the returns of the underlying index they track, providing investors with diversified exposure to a broad market or a specific sector. Unlike hedge funds, index funds aim to achieve market returns rather than outperforming them. 2. Risk and return profiles. Hedge funds. Hedge funds are known for their potential to generate high returns due to their active management and flexibility in employing diverse investment strategies. The aim is to produce positive returns even in bearish markets, making them attractive to investors seeking alpha. However, their pursuit of higher returns often comes with higher risks, including exposure to leverage and concentrated positions. Consequently, hedge funds can experience significant volatility, and not all funds succeed in beating the market consistently. Index funds. Index funds, being passively managed, typically offer lower risk profiles compared to hedge funds. By tracking the performance of a market index, they diversify across multiple securities, reducing the impact of individual stock fluctuations. While index funds may not achieve exceptional gains like some hedge funds, they provide stable, predictable returns that closely mirror the overall market performance. Consequently, index funds are favored by risk-averse investors seeking a more hands-off, long-term investment approach. 3. Fees and costs. Hedge funds. Hedge funds are infamous for their relatively high fees and costs. Managers often charge both a management fee, usually a percentage of assets under management, and a performance fee, a percentage of profits generated. These fees can significantly eat into an investor's overall returns, making it crucial to carefully consider the fund's performance relative to the expenses incurred. Index funds. One of the main attractions of index funds is their low cost. Since they operate passively and do not require active management, the fees associated with index funds are typically significantly lower compared to hedge funds. This cost advantage is particularly appealing to investors who prioritize minimizing expenses while maintaining market exposure. 4. Liquidity and accessibility. Hedge funds. Hedge funds are often illiquid investment vehicles, meaning that investors may have limited opportunities to redeem their investments and cash out. Many hedge funds have lockup periods during which investors are not allowed to withdraw their funds, often lasting several months or years. Moreover, hedge funds are generally restricted to accredited investors with high net worth or institutional clients, making them less accessible to the average retail investor. Index funds. Index funds, being publicly traded mutual funds or ETFs, offer high liquidity to investors. Investors can buy or sell shares on the open market throughout the trading day, providing flexibility and ease of access to their investments. Additionally, index funds are available to a broader range of investors, allowing retail investors to participate in diversified market exposure with relatively low initial investment requirements. Conclusion. In summary, hedge funds and index funds represent two distinct investment approaches, each catering to specific investor preferences and financial objectives. Hedge funds offer the allure of potentially higher returns through active management, but come with higher risks and substantial fees. On the other hand, Index funds provide investors with low-cost, passive exposure to broad markets or specific sectors, offering stable, market-matching returns. Ultimately, the choice between hedge funds and index funds depends on an investor's risk tolerance, investment goals, and time horizon.